In this video, we're going to review 9 Dividend Aristocrat stocks to buy now at bargains. The S&P 500 just wrapped up its worst first-half performance since the Nixon era, with shares ending down more than 20% for the 6-month period. Few areas of the market were spared, but, fortunately, investors can look to the Dividend Aristocrat stocks to help cushion the blow, and now, they can get some of these elite income plays on the cheap. The Dividend Aristocrats are a group of 65 S&P 500 dividend stocks that have increased their cash distributions for at least 25 years in a row. One of the best safe havens for investors can be found with the Dividend Aristocrat stocks, which are noteworthy for their resilience and steady income. The defensive characteristics of Dividend Aristocrats is evidenced by their proven ability to outperform other stocks during market downturns. These Dividend Aristocrats, many of which are trading at deep discounts to their historic valuations, offer a rare opportunity for investors to capture the compounding power of steadily rising dividends at a lower share price. Here are the 9 Dividend Aristocrat stocks that are currently trading at bargains. Number 9. S&P Global, SPGI. Standard & Poor's, SPGI, is one of the big 3 credit rating companies, along with Moody's and Fitch. In addition to being a leading provider of credit ratings, related research and analytics, SPGI is the largest domestic index provider, supplying a wide variety of financial benchmarking tools, and a leading gatherer of market intelligence and analytics through its Capital IQ business unit. Dividends have risen 49 years in a row and 15.5% annually over 5 years. Payout is an ultra-low 23%, suggesting the current dividend is easily maintained. This Dividend Aristocrat has not been immune to broad market headwinds, with SPGI shares down 26% in 2022. It's currently trading at 1.5 times its forward PE, price earnings to growth, which is a nearly 21% discount to its 5-year average. Number 8. Sherwin-Williams, SHW. Sherwin-Williams is the industry leader in paints, coating and related products. Its familiar brands include Valspar, Dutch Boy, HGTV, Krylon, Minwax and many others. The company owns more than 4,800 specialty stores mainly across North America, and caters to contractors and DIY customers. Sherwin-Williams has increased dividends 43 years in a row, including a 9% hike in February. Number 7. Pentair, PNR. Pentair is a leading provider of water treatment solutions including filtration products, pressure tanks, control valves, pool equipment and accessories and other products to residential and commercial customers. The company generated $3.8 billion of sales last year and has operations in 30 countries. Pentair's water treatment business is benefiting from new connected digital technologies and a post-pandemic recovery in industrial and food service demand. PNR has increased its dividend 46 years in a row and generated 15% annual dividend growth over the past 3 years. Pentair is an impressive generator of free cash flow, which typically matches or exceeds net income. The company aims to return 50% of free cash flow to investors each year via dividends and share repurchases. The company is guiding for 2022 sales that are 11% higher on a year-over-year basis and adjusted EPS gains of 9% to 12%. They are currently trading at a low 12.6 times forward earnings, which is a 32.2% discount to Pentair's historic average multiple. Number 6. PPG Industries, PPG. PPG Industries is the world's second largest manufacturer of paints, coatings and specialty materials behind Sherwin-Williams. PPG's principal markets include paints for automotive OEMs, original equipment manufacturers, refinishing, architectural, aerospace, protective and marine and industrial applications. The stock is among the deeply discounted Dividend Aristocrats, trading at 17 times forward earnings and a more than 13% discount to its historic multiple. What's more, PPG has generated 50 years of rising dividends, including 8% annual dividend increases over the past 5 years. And a modest 37% payout should keep this dividend safe, even if EPS growth proves challenging this year. Number 5. Lowe's, LOW. Lowe's operates nearly 2,000 home improvement stores across the US and Canada, serving approximately 19 million customers per week. Compared to its principal competitor Home Depot, Lowe's is more focused on the professional contractor segment. This group typically makes significantly larger purchases per transaction than DIY customers and are thus a more lucrative business segment that can support higher margins. The company is guiding for comparable store sales to be roughly flat in fiscal 2022, while EPS will arrive between $13.10 and $13.60, up 11% compared to last year. Lowe's was trading at 52-week lows in June amid expectations that rising interest rates would dampen housing demand. While the shares have come off this bottom, they are still down nearly 31% for the year to date. However, Wells Fargo analyst Zachary Fodham recently reiterated an overweight, buy, rating on Lowe, saying the stock could be a defensive play if there is recession. Number 4. Stanley Black & Decker, SWK. With revenues last year exceeding $15.6 billion, Stanley Black & Decker ranks as the global leader in outdoor power equipment and power tools, hand tools and engineered fasteners. The company has built its worldwide franchise around well-known brand names like DeWalt, Craftsman, Lennox and Troy-Bilt, along with its familiar Stanley and Black & Decker brands. In its March quarter, SWK grew revenues 20% and adjusted EPS came in well above analysts' consensus estimate. The company is guiding for mid-20% revenue growth in 2022 and free cash flow ranging from $1.0 billion to $1.5 billion. So far in 2022, the company has spent $2.3 billion on stock buybacks that have reduced the number of shares outstanding by nearly 8%. The company is as steady as dividend aristocrats go, having grown dividends 54 years in a row while maintaining a low 30% payout. Number 3. Target, TGT. Big box discount merchandiser Target is the 8th largest retailer in the U.S. and owns more than 1,900 stores across all 50 states and Washington, D.C. It is estimated that 75% of the U.S. population lives within 10 miles of a Target store. During the pandemic, TGT was a top stock as Americans flocked to big box stores to load up on food and household essentials. After a similarly strong financial 2021 performance, Target encountered headwinds this year due to overestimating the strength of consumer demand. TGT shares plummeted in May as a result of March quarter adjusted EPS that widely missed estimates and a reduction in 2022 guidance. Despite current headwinds, TGT offers a solid long-term performance showing 20% annual EPS growth over 5 years and nearly 11% growth over 10 years. Like several of the dividend aristocrats featured here, the company is also a dividend king. And in June, it rewarded investors with its 51st consecutive year of hiking dividends, increasing its cash payout by 20%. With payout set at an exceptionally modest 28%, it seems likely that TGT can continue growing its dividend even if the retail environment softens in the near term. Number 2. T. Rowe Price Group, TROW. Asset managers like T. Rowe Price Group have taken an outsized pounding during this year's bear market, but this high-quality mutual fund giant has compiled a solid track record of outperforming its industry peers. T. Rowe Price provides a broad array of actively managed mutual funds, advisory services and account management for individual and institutional investors and retirement plans. As far as dividend aristocrats go, the long-term financial performance of this one has been stellar, with EPS rising an average of 19% annually over 5 years and 15% over 10 years. And this has been accompanied by 36 consecutive years of rising dividends. Dividend growth has averaged more than 15% annually over 5 years, and the firm's low 36% payout provides a safety margin if earnings decline in 2022. Number 1. VF Corp. VFC. VF Corp is a global leader in branded apparel and footwear. Its iconic Timberland, North Face and Vans brands comprise almost 80% of total sales. Fears of a looming recession that will erode consumer spending have hurt VFC shares this year, with the stock down almost 40% so far in 2022. VFC has delivered 49 consecutive years of dividend growth, averaging 5% annual hikes over the past 5 years. Share price weakness in 2022 has made VFC one of the most deeply discounted dividend aristocrats, and pushed the retail stock's dividend yield up to 4.5%, which is roughly twice its 5-year average yield. Which of these dividend aristocrat stocks would you like to add to your investment portfolio? Let us know in the comments below. Thank you for watching and don't forget to subscribe to our channel for weekly investing and personal finance videos.